Hi, my name's Martin Cavey from Chorus Accounting, and one of the questions I get asked a lot at the moment is that business owners have built up reserves in their company. They haven't taken all of that out because there are tax consequences to doing so, but they then want to close their company and they need to understand what the ramifications are of that and what taxes might be there. So one of the things that you can think about doing is about closing the company and doing something called a capital distribution. Well, the first thing to understand about a capital distribution is it's not involving income tax. Income tax can be done on a dividend and would be 7.5%, 32.5%, 45%. They're quite chunky numbers. But if you qualify for a capital distribution, the tax that you pay is capital gains tax. But what's capital gains tax? Hold on a minute, Martin. Capital gains tax, that's another tax that we want to talk about. Capital gains tax is when you dispose of an asset. That's what it's all about. So you're changing, if you like, the value of your shares, which are the asset that you own, and you're changing those into cash. That's going to trigger a capital gains tax event, and that means you're going to pay capital gains tax, potentially. But why is capital gains tax favourable to do that as a capital distribution rather than income tax? Well, we know that income tax is on a dividend and is going to be paid at either 7.5%, 32.5%, or 38.5%. But don't forget, you've already paid corporation tax on that number at 19% at the moment, but those rates are going to increase. So that comes out at, let's say, if it's the highest rate, potentially you're paying at 57.5% tax to get your money out of your company that you've worked really hard for and don't really want to pay that tax. So you could look at a capital distribution and we come back to capital gains tax. Capital gains tax at the moment is either a flat rate of 10% or 20%. That's what it is on disposal of shares in a trading company. And that's really important because a trading company means it sells goods or services over a period of its life. If that company has rented out property, then a capital distribution is potentially not allowed. And there's specific anti-avoidance legislation to counter that change. If you're not sure what that anti-avoidance is, then come and have a chat with me, because it can get quite complicated. But if we go back to what a capital distribution is, you're changing effectively the tax rate from, 58.5% if it's a large number, to 20%. Now obviously that depends on what our Chancellor decides to do, and we all know he changes his mind at least twice a year, once in October, once in March, and tells us what the new tax rates are going to be. What we can do at the moment is go, okay, the tax rate is 10% or 20%. So you're going to end up, say, with a distribution paying tax at 20% on the value of your reserves, rather than the dividend rate. That's obviously advantageous to you, but you need to make sure you've planned to do that in the right way. The other thing to consider about it is if your reserves are more than £25,000, then you're going to need to involve an insolvency practitioner. I'm not one of those. I don't profess to be one of those. But an insolvency practitioner goes through a formal process of closing down a company. When your reserves are more than £25,000, that's what you need to go and do. And they will charge you a fee for doing that. That's nothing to do with me, that's just a relationship with them. But what it does mean is that they put in place some guarantees that are going to make sure that the money comes to you in the right way. If your assets are under 25,000, then you can just write that off to Companies House, send them a letter, fill in a form, give them £10, and they will start closing down the company. That's all well and good. But remember Her Majesty's Revenue and Customs. That's right, HMRC are still in the background, they're still considering things. If you just write to Companies House and say, I'm going to close my company, and you've traded for 10 or 12 years, it is every chance that Her Majesty's Revenue and Customs will object to you writing off the company. They just won't let you do that, because they think there's tax that they might need to collect. So whilst this process is going on, what you also need to do is write to Her Majesty's Revenue and Customs and tell them what you're doing. Give them the figures. Tell them that all their tax is going to be paid, and they will allow you to do it. That's the easiest way forward and ensures that you get the money to yourself in the most efficient way possible. Obviously, what I've said is complicated. You're talking about dealing with a Majesty's Revenue and Customs, Companies House, suppliers, customers. There's lots of moving pieces. So why not leave a comment below and I'll come back to you to help you through the process. If you found this video interesting, then why not look up this one?